Time to get passive aggressive now, where we track the shots fired in the battle between active and passive investing. And ETFs are usually a tough nut for mutual fund companies to crack, but PIMCO, the bond giant, got into the ETF business early, and it's paid off. Its assets are now north of $20 billion in ETFs. So who better to discuss this than David Braun, who manages the PIMCO Active Bond ETF, better known by its ticker BOND. Great to see you, David.
Thank you for having me, Scarlet.
So with all the volatility in equities, fixed income clearly is in favor, and fixed income ETFs are on track for a record year of inflows. And this will be the first year in 10 that fixed income takes in more funds than equities. As an active bond manager, how significant is this?
Yeah, so as you mentioned, we were early to the ETF bandwagon, right? 10 years ago, we launched the first actively managed fixed income ETF, and we felt the ETF vehicle would be a great place for us to deliver our fixed income strategies to investors. And as you point out, first time in 10 years, fixed income flows are trending higher than equity flows in ETF. We think that's great. I think a couple reasons why that exists. One, you look at the volatility in the equity markets in the fourth quarter of last year, it really woke investors up to the fact that you need bonds in your portfolio as insurance against equity risk. Second, there's been a renewed fear in the market on where global growth is heading, right? We've been talking about this for a while. And in a lower growth environment with greater volatility, bonds are a key part of one's portfolio. And then on the active side, because that's the topic of the show, if you look at the trend there, not only is fixed income growing faster than equities, but active fixed income is gaining a larger part of the pie, right? 2-3 years ago, it was only 5%, now it's almost 10%. So PIMCO is happy about the growth in fixed income in ETFs and happy about the growth in market share for active fixed incomes.
But when you look at the flows into fixed income ETFs, a good chunk of that is going into funds that track the AG, which is your benchmark. Eric likes to call the AG the Washington Generals of benchmarks because it's so easy to beat, you know, compared to the Harlem Globetrotters. And the numbers certainly back it up. Now, if that is the case, why are investors buying these funds that are tied to the AG index, like BND, like AGG?
Yeah, so I mentioned how 10% is active, and we're happy about the rate of growth of that, but still 90% is passive, right? And they're trying to replicate an index like the AG, as you mentioned, right? So we believe in ETFs, the move into passive fixed income has been largely inadvertent. If you think about it, ETFs came into their own as a vehicle for equity funds. And in equity funds, a lot of investors believe that it's hard to beat the passive benchmark, so therefore go passive. So then when fixed income started to grow in the ETF channel, it was almost a knee-jerk reaction. It was like, oh, it's an ETF, I want bond exposure, I should get passive. You look at mutual funds, only 25% or thereabouts are passive versus the 90% in ETFs. And as you mentioned, that the indices are flawed, and there's some structural reasons why they're flawed. The one example I like to give investors is the indices are debt-weighted. So you, by definition, buy more bonds for the most indebted issuers. I always use the analogy for people to keep it simple, that if you owned a bank, and imagine someone came into your bank and said, I want to get a loan from you. And your first criteria and your only criteria was really, well, how many loans do you have outstanding already? And if they said a lot, you give them a big loan. If they say none, you give them no loan. We try to do the opposite at PIMCO, where we're lending to people for more important reasons than that.
No, when we talk about the AG as a benchmark, it's pretty vanilla and it's pretty easy to beat. Do you think we'll get to a point where we'll get more sophisticated benchmarks that are be used to measure bond managers, active bond managers, and fixed income ETFs against? Near Kesar writes about this, talking about a great bond index apocalypse coming for these managers.
Yeah, I saw that. I think what people are getting at with that discussion is smart beta, right? So we can all agree that the indices are flawed, so let's use some smart beta or factoring approaches to create better indices. And we would certainly agree with that, and we're certainly looking at strategies there. But the thing I'd caution people on is a lot of these smart beta strategies simply just lever up beta. And what we as an active manager are trying to deliver is alpha, not beta. And the most notable beta people always lever up is credit beta, right? And if you look at history, if you own credit through multiple decades, you're going to cultivate most of that spread above and beyond the credit losses you incur. The problem we have with that strategy is by just being systematically overweight credit in all markets, once a cycle, you drive your customer's car into the brick wall at full speed, and you incur massive credit losses. Now, we don't profess to be perfect at timing cycles, but we think we have to try to get the clients out of harm's way. And when you see froth in the market and low spreads and high leverage, it's better to de-risk and not just add more beta. So again, we're trying to add alpha and not beta.
Right.
I think a lot of these sampling methods are just adding more beta.
Big distinction there. Speaking of distinctions, there are some big differences between bond and AG, specifically the mortgage holdings and treasury holdings. Could that change? Talk a little bit about that.
Yeah, so what we're trying to do in bond, and we try to do this in all of our portfolio, Scarlet, is deliver a more diversified basket of bonds, right? So indices are pretty generic. They stick to pretty generic asset classes. And diversification is powerful because it's a tool where you can actually cut your risk a little bit. You can cut your risk by diversifying your bets across the broader part of the market. And you can also add upside return because you're buying less trampled over assets than the generic stuff that's in indices. So in bond, what we're trying to do is be very cautious on corporates. And I don't know if you popped it up, but we have roughly benchmark weight in corporates, but the devil's fully in the detail.
Yes.
We're double the weight in financials because we think bank balance sheets look pretty darn strong, and we're underweight non-financials. And in mortgage space, we have a lot of non-agency mortgages and asset-backed securities in there.